The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Hi, everybody. Welcome to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner. I'm here with Jeff Perry, my co-host. And thank you all for being with us. We have a great guest. You're going to learn a lot. I've had the benefit of talking with our next guest on another podcast for our Wicked Pissa podcast, but I learned a lot. And yet, Jay Frank from Cantor, Fitzgerald Asset Management, not only are you informative, but you're entertaining. You get a lot of energy, and it's a lot of fun to talk to you. So thanks for being with us, Jay. Jay is the president and chief operating officer of Cantor Fitzgerald Asset Management. Thanks for being with us.
Yeah, thanks a lot for having me, Chris and Jeff. My pleasure.
You know, I know you want to make sure that we get a disclaimer in right off the bat. So let's just make sure we get that dealt with.
Yeah, I appreciate it. Just as Chris mentioned, I'm with Cantor Fitzgerald, and we're going to have a lot of fun here over the next 20 minutes or so. But just realize that myself and Cantor, we do not give tax, investment, or legal advice. We leave that to the experts like Jeff and Chris and the tax experts out there. So make sure you are working with a professional in these areas if you're considering it for investment.
All right. But that said, you're going to learn a lot about some great ideas as it relates to real estate and tax planning, tax considerations. And there's a lot of, people are familiar with the idea that, hey, there's some advantages to owning real estate. You get to depreciate and things like that. But a lot of times when it comes to investment, one of the things that we worry about when oftentimes I talk to people, that they are too concentrated. They might have too much money in a single investment, so, and as people age, we deal with people in retirement, Jay. So, as they age, they may be less interested in being a landlord and some of the challenges that can, produce. So let's talk to start off with explaining to people what's a 1031 exchange? How does it work? What are its virtues? And why do people consider trying to do this?
Yeah, my wife and I actually we live in the West Coast, but we have a rental property that we Airbnb, and I just got the invoice for 2 new water heaters. So
you're starting to question the virtues of that.
Yeah, and a request for my little brother to stay there for free with his family. So
of course, that's
right. That's right.
I understand.
It's a lot of work, especially like around here. I'm on Cape Cod. People have to, in the summertime, they have to go and mow the lawn and clean out the houses between rentals.
Oh, come on! Just watch TikTok. It's easy, passive income. You just buy stuff and sit there and get the checks.
Yeah, not always though, right? Yeah. Okay.
That's right. We need a show. You need a show on TV, like all those shows, like the home buildings show,
reality show. Yeah.
Yeah, that you can redo a whole kitchen for $17.
Right.
You guys need something for financial advice. That you need the what's full swing for golf. You guys need like that show for.
There you go.
Oh, I thought you were going to say about being a landlord.
That too, or for being. There's enough of those out there, Jeff. There's enough
I guess.
Already out there. But Chris, what was the question? Was the basics of 1031s?
Yeah.
So 1031 exchange, it's something like 103 or 104 years old now. So it's IRC section 1031. I think that's the most important thing to remember, is that this is a long-standing part of the tax code, and you'll hear a lot of people say that it's the most powerful tax strategy available to investors. And essentially, when you sell a piece of investment real estate, so not a primary residence, but something that's held for investment purposes, like a rental property, when you sell that, as long as you can exchange the proceeds following the rules of the program, within the allotted time of the program, generally 180 days, then you can defer any tax recognition indefinitely.
So that's the huge benefit. If you have a property, you've maybe depreciated it, even fully, right? You may want to say, oh, I'd like to start over, or, do it again with another, reposition this into another property, but I don't want to pay that capital gains tax. Here's the idea is you can do a like kind exchange is what they call it. It's where you essentially swap this property for a different property. But in the process of doing that, Jay, there's some rules that are really important that you have to follow, and you don't just get to take that money and do it again. You have to follow some particular protocols. Maybe you can just elaborate on some of those protocols.
Yeah, and I'll start with what you said is like kind, because that's right. And a lot of people mistake that as thinking, oh, I owned an apartment, I have to exchange into an apartment. Like kind, it just means investment real estate to investment real estate. So you can sell an apartment and buy an office building. You can buy an office, sell an office building, and buy a strip mall. You can sell a strip mall and buy a hotel.
It's still investment real estate, whichever type of investment real estate.
Yeah, where the confusion comes from is you used to be able to 1031 exchange, collect personal property like cars, aircraft carriers, a fleet of trucks, livestock. I'll give you, I'll sell 10 of my cows and buy 14 donkeys or something. So you couldn't sell real estate and buy donkeys. That wouldn't be like kind. So that's number one rule. So we're talking about investment real estate here. The Tax Cuts and Jobs Act of 2017, which we'll get to later on a different topic, that changed Section 1031 and restricted it only to real estate. So it wasn't that long ago that if you were selling a fancy painting, you could exchange the proceeds into another piece of art. So anyway, that's one rule to keep in mind. The second big rule, let's just talk about timing and what's called constructive receipt. So if you sell a rental property for $1 million, Jeff, you can't receive a check. That would be constructive receipt of the proceeds, taxable event. So you need to work with what's called a qualified intermediary and your real estate agent that you're probably working with, and your selling contract when you're selling that property needs to instruct to have the sale proceeds go to a qualified intermediary, kind of like an escrow account at a bank. There's a lot of them out there. There's a few big ones. They're easy to find. It's short for qualified intermediary is QI. That's the lingo. So your money goes and sits at a QI. It earns interest more now than it did a couple of years ago. And you want to negotiate that because the QI is trying to keep the interest, but you want to ask for your interest. 5% is a real number all of a sudden. So the money sits there and that starts your clock. So you have 45 calendar days to what's called identifying or IDing your replacement properties, which essentially is telling the QI the names, the addresses, and some basic information. Very easy to do, but the hard part is you only have 45 days to do it. And there's different rules to identify. The main rule that's used 95+% of the time is what's called the 3 ID property rule. So you can identify up to 3 replacement properties, and when you have to close on 1, 2, or all 3 of them. That's the most simple one. You can get more. You can Google it and learn more about the 95% rule, the 200% rule. But once you're beyond 45 days, that ID period is over. You can only invest in 1, 2, or 3 of those properties if you use that rule. You have a total of 180 days. So 45 ID, an additional 135 to close on those properties. If you don't, taxable event. If you do, as you said earlier, Chris, you defer the recognition of all capital gains and defer the recognition of all depreciation recapture tax. The last key rule is you have to replace your equity equal or more and the purchase price equal or more. So when you're selling a piece of real estate, so Jeff had that $1 million property, he has $400,000 of equity and he has a $600,000 loan. So 400 equity, 600 debt, $1 million property. He's going to have 400,000 equity or more in whatever he exchanges to, and it has to be $1 million property or more of whatever he exchanges to. Those are kind of the simple rules. It's equal or more equity and price. You don't have to replace your debt. Debt can be replaced with equity.
That's terrific. I mean, I think that gives a good understanding, and it is can be complex in that sense. So, gotta follow these rules. Got to make sure you're adhering to. You can't just take the ownership and say, "Oh, I'm planning to do an exchange." Too late. You got to follow, like, use an intermediary and all that.
Yeah, in most cases, the buyer of the new property, seller of the original properties already get those properties scoped out before they are dealing with this 1031. Hopefully they should be, right?
Yeah, because that 45, I mean, for anyone that's ever bought a home before, 45 days just isn't a long time to find diligence. I mean, people look at properties for a couple of years trying to find something, so you want to, Jeff, to your point, it's a great point. You want to be working with professionals can help, but you really want to have this kind of premeditated, if you will.
Mm-hmm.
So, and in that case too, it gives you, when you have the opportunity to go with, a larger investment, you can then have the opportunity to depreciate again or more if people are, at a point where they need that benefit to be able to depreciate further. Let's talk about the issue of, though, I don't want to be a landlord. What are my options then?
You don't want to buy 2 new water heaters for $5,000 like I'm about to do?
Yeah, right.
So, the industry lingo is the T's of real estate investing, and so it's trading. It's not wanting to deal with tenants, trash, taxes, and how we make water heaters. There's a T in the show. So, water heaters. It's trading that, and somehow maintaining your tax status, meaning deferring your tax. Probably wanting to generate income, maybe tax advantage, like you said, from depreciation, but maybe not dealing with those T's. That's where a provision of the code, a revenue ruling passed in 2004. It's 2004-86. That revenue ruling created a very easy use of passive ownership, fractional ownership of real estate that will qualify as a 1031 exchange. So let me try and say it a little more simply. Basically, and you could do this with TICs going back even longer, 10 in common, but there's a trust called a Delaware Statutory Trust, or DST, that can essentially buy an asset, say $100 million multifamily property. And Jeff, who's selling his $1 million apartment in Boston, instead of trying to find a new $1 million replacement property on his own with all the the rules and complications we talked about, Jeff could buy $1 million fractional interest in that $100 million multifamily by buying interest in the DST. And there's a lot of rules for that DST to qualify as what's called real property, thus making it eligible for 1031 exchange placement purposes. So it's kind of, some people call it a securitized exchange, some people call it a passive exchange, but you're essentially going from those first set of T's, what was it, taxes, toilets, tenants, and water heaters, and you're exchanging that more for passive real estate ownership, which is, I don't know, the tennis, tea time, and travel. Basically, you're not spending time managing your asset. You're collecting rental income more passively, and someone else is identifying the property, financing the property, managing the property, and passing monthly or quarterly cash flows to you. You're going to pay fees for that, right?
Sure.
And you're going to give up some control decision because you're now one of many investors, not just someone that owns a property. So there are definitely considerations and risks, unique risks to this to consider. But for someone that's looking for passive ownership, or for someone that can't find that replacement property inside of that 45-day period where you kind of have a gun to your head in a way, it can be a nice solution.
What are the liquidity considerations when dealing with something like a DST?
Yeah, I mean, almost every DST I see out there, and there's, I don't know, 70 or 80 peers of ours, other real estate companies that do these, probably even more than that. So there's a lot of this out there. I believe, I don't know, $6, $7, $8 billion a year is invested in DSTs. These specific types. Forget 1031, which is probably 10 to 20x that amount.
Right.
But these DSTs, it's a pretty big industry. But most DSTs own a single asset. Okay, so it's that $100 million multifamily. In theory, you can own multiple properties in a DST, but to keep this simple, think that it's a single asset. Generally, the DST is highly illiquid for the whole period, and the whole period is typically 5 to 10 years.
Okay.
There's restrictions on what you can and can't do inside of that DST, and one of those restrictions is you can't refinance the debt. And so, because it needs to remain passive, and so usually DST sponsors will put conservative leverage, say 30, 40, 50% debt on the asset, and they'll use long-term 10-year, which is the equivalent of a 30-year home mortgage, right, in commercial real estate. They use 10-year fixed rate, typically interest only or amortizing debt. And so the business plan is to sell that asset within that 10-year period before you get close to that debt coming due. So think of it as a 5 to 10 year, 6 to 9 year commitment where there's limited liquidity. There are some secondary markets evolving where you can sell your interest to someone else, but by no means are there all those developed markets. And when I see trades happening in those markets, it's at significant haircuts. It's not a
big discount.
It's interesting, a financial emergency for someone. It's not I just want to do something else with the money. Let me just go sell this on a secondary market. So it's a long-term commitment.
Well, would this be a good point to transition and talk about what is a qualified opportunity zone? You mentioned the Tax Cut and Jobs Act earlier, and maybe you can elaborate on a different type of technique that people can utilize.
Sure. So it's the Qualified Opportunity Zone program, or the QOZ program, was created in the same Tax Cuts and Jobs Act. What is that? 6 years ago next month. That restricted 1031s to only real estate. So taketh and giveth. And the QOZ program works for investment real estate, but it also works for personal real estate, like a home or a vacation home. And it also works for any other type of asset. So this was bipartisan legislation when it was born, when it was passed, when it was implemented. And believe it or not, 6 years later in Washington, D.C., it is bipartisan. It is still highly bipartisan. There's some people that don't love it, but it's very bipartisan. And Tim Scott just dropped out of the presidential race, as we saw a few days ago. And Tim Scott was the lead Republican on the original legislation, along with Cory Booker, Democrat from New Jersey. So the OZ program was getting some nice free press from Tim Scott's campaign trail, and I'm sure it's also part of Trump's because it was passed under his administration. But it was very bipartisan. That's important to understand, and it's pretty good legislation, we think. Basically, the government is trying to stimulate investment, job creating, economic driving investment in lower income communities. And so it's like, how do you do that? There's the LIHTC program for low income housing. There's a lot of ways that the government tries to stimulate this type of stuff. So this program is in that same vein, and it basically says, hey, if you're an individual like Jeff or Chris, or if you're a business like Cantor, Fitzgerald, or AMR, or StreamYard, I think what we're using to do this podcast. If you're a business with a gain, either one, individuals or entities with a capital gain on any type of asset that's taxed as a gain, short or long term, if you invest those gain dollars when you sell the asset in a opportunity zone fund that develops real estate, substantially improves real estate, there's a definition of that, or starts businesses and following the rules of the QOZ program, then you qualify for some lucrative tax benefits. Most OZ funds that we see in the United States are real estate driven, and they're developing real estate. So think of these as, instead of that $100 million multifamily, Jeff, that you were exchanging into earlier, that's already built, it already has tenants, it's already cash flowing. Someone's building that building from the ground up. They're buying dirt, they're buying an old property, they're tearing it down, and they're building something. And these programs, you need to hold it for 10 years or longer to qualify for the main tax benefits. So again, they're highly illiquid. And so they're not for everybody. Sophisticated investors, that they understand the illiquidity, but the tax benefits are pretty attractive. Think of it as kind of like a Roth IRA. So what's a Roth IRA? After tax money, growing tax free. So with the OZ program, here's how I equate it to a Roth IRA. You had $1 million. Let's say Chris, this time you're the rich guy with the $1 million. Jeff's been rich enough.
Hey, all right. Let's say.
So I'm willing to share.
You had bought Amazon stock for $1 million, and now it's worth $2 million, which is probably better than that. But you have $1 million gain, and you
kept it for a month, and then I moved on. Yeah. Okay. We're just teasing. Okay.
You've owned it for November. It's been a pretty good November so far. So you sell your $2 million position. Your $1 million basis is so you get to take that out tax free. And you're dealing with $1 million gain, right?
Yeah.
State and federal taxes on that gain, 30 to 35% all in, depending on your state and all that. If you invest that $1 million in an OZ fund within 180 days, there's no ID period, there's no 45-day period, there's no QI. It's much easier to do. You just have to find a fund, an OZ fund that's open, and you invest your $1 million.
So in this case, it's the $1 million of gain. I don't have to do the whole $2 million I invest, what I invested and what I gained. It's just the gain.
That's right, just the gain or some portion thereof.
I don't even have to do the whole thing. If I'm willing to pay tax on $500,000, I could do half that.
That's right. And you'll get the tax benefits on the portion you invest. It's a little different than 1031, which doesn't quite work that way. You really, in 1031s, you want to do it all. We won't get into the details. But if you invest $1 million in the OZ, you defer paying your taxes on that until 2027.
Okay.
Instead of it being a 2023 gain, it's a 2026 gain. Paid
so
in
the calendar year, tax year 2026, it becomes a realized gain. And that's just on what I deferred, right? Or it has nothing to do with what it's happened since then in this new qualified opportunity zone, right?
Yeah, that's right. So the key is you're going to pay taxes on that gain. So at that point, this becomes after-tax money, like a Roth IRA.
Yeah.
But you need to continue holding the OZ fund for a total of 10 years. Once that OZ fund is liquidated, prior to 2048, but once that fund is liquidated, as long as you personally owned it for 10 years, whatever it sells for, your basis steps up to that price, aka fair market value, at that time. And so
there's really two tax benefits here, if I'm understanding you right. There's the deferral of capital gain until the tax year 2026 paid in 2027 on the investment that I had the gain on. And then on whatever happens with the money I invest in the qualified opportunity zone investment, 10 years later, presumably that's worth more. I get to benefit from that investment gain without having to deal with a tax consequence.
That's right. The first tax benefit, the deferral, is much smaller, but important to understand, it's that step up in basis. It's the equivalent of passing away without having to pass away.
Yeah.
There's 2 ways to get a step up in basis. There's 3 ways to get a step in basis: death, pay taxes, or the opportunity zone program. And that second tax benefit is what the program is all about from a tax point of view. And it's critical to understand you're developing property or you're starting a business, right? And so you're talking about activities that are designed to generate significant returns, right? And so those gains, if there are significant gains, they're all tax-free. We'll take it one step further. You're building a building, and then you're going to start depreciating that asset. All of that depreciation is going to lead to more tax-efficient rental income distributions to the shareholders during the hold period. And all of that gets stepped up at the end, meaning all of that depreciation recapture is eliminated.
So you're never going to be taxed on that.
You're never going to be taxed on it. So it's a double tax benefit on the step up in basis.
Yep.
You can also own an OZ inside of an irrevocable trust where you don't get a step up in basis even upon death. Right. So you get into some more higher end estate planning considerations. And there's a lot, that's where you bring in the estate planning attorney, you bring in the Chris and Jeffs of the world, you bring in the CPA, and there's some higher end tax, wealth, estate planning consideration with these programs.
I think it's really intriguing. Like, Jeff, isn't that interesting? Like, it's not something people, I think, hear enough about. But that being said, when does the role of being an accredited investor, which is to say there's some specific, implications of how much wealth you have or how much income you have, come into play with either of the 1031 exchange or the opportunity zone, qualified opportunity zone?
Yeah, almost every DST, that's that 1031 vehicle we talked about, those programs are restricted to accredited investors. What is it, $1 million net worth, or there's certain income rules depending on what state you're in. But again, the government trying to equate wealth and income to sophistication, which, as we know, is not always the case. But they assume you're sophisticated in making foreign investment decision because, like we talked about, there's risk of real estate, there's risk of the illiquidity, and those are things that need to be understood.
Given thought, yeah.
On the opportunity zone side, you'll see programs that are either accredited investor, the same, sometimes what's called a qualified client, which is just over $2 million, or a qualified purchaser, a QP, which is over 5 million. Different programs are structured different ways, but again, it goes back to sophisticated understanding what you're doing and the risk factors to get some of these return and tax benefit potential, and understanding the long-term commitment that you're making. So that's typically what you see.
Okay, so maybe not for everybody in this kind of scenario, but worth being aware of for those who may run into this kind of an opportunity to try to deal with some tax advantages. What are the risks? You mentioned that this deals with a qualified opportunity zone. It deals with certain geographic considerations.
Mhm.
Is the way the performance of the real estate portfolio performs different in some of these potentially lower income areas?
There's over 8,700 opportunity zones in the United States. So if you're new to this program, just wherever you live, Boston opportunity zones, just Google it. You'll be shocked at some of the areas that you probably go out to dinner or frequent, or your kid's soccer facility or whatever. You'd be surprised. But a couple great examples: the SoFi Stadium, the Chargers and Rams in LA, it's an opportunity zone. All 5 boroughs of New York City, including Manhattan, have opportunity zones. The Raiders Stadium, Al Davis Stadium in Las Vegas. So there's Mojave Desert. There's the opportunity zone, half of Alaska opportunity zone. But so it's far and few between. There's a lot of great places to invest capital. Like, we're building the tallest building. We just topped off the tallest building in the state of Utah. It's downtown Salt Lake City, a couple blocks from Goldman Sachs's regional headquarters. So is that a good or bad place? Like, the fact that the census, based on 2010 census, meets the definition of a low-income community does not mean it's a bad place to invest money if there's heightened risk necessarily. So
okay, that's something I wanted to address. And then, in the world of politics and investing, there's been all this heightened attention to the idea of ESG, and some people are all for it and some people are all against it. You talked about this qualified opportunity zones as being bipartisan. The reason being, one has an investment benefit and there's a free enterprise component to this.
Right.
While at the same time, it can be helpful to various, economic jobs and opportunities in the process. So I don't know, just elaborate on that a bit for a minute,
Yeah, I put in the bucket of impact investing, which is the point is you don't have to sacrifice return to do good. And so, the taxpayer is subsidizing these investments, right? And the idea being that if you build a bunch of $100 million, $200 million, $300 million towers, one in Salt Lake, one over here, one over there, in these low-income communities, think how many construction jobs, how many union jobs. A lot of the developers are using a certain percentage of minority and underrepresented segments of the U.S. population in awarding contracts. Once you build that office building, someone's going to be occupying that building. You're attracting employers, and what do employers do? They hire employees, and so you're bringing people into this low-income community. And when you get off of work at 5 or 6 o'clock, sometimes you go home. Sometimes you go have a drink. Sometimes you stop at the grocery store.
Buy a meal. Yeah.
And so you're spurring investment in this community. That investment banker, a couple years out of college, is making $150,000. They might go move to that opportunity zone, in an apartment, because it's walking distance from work. And all of a sudden, so it's, I don't want to say trickle down economics, but you're spurring investment, job creating, economic driving activity in these lower income communities. And at the same time, it's private investment, building buildings and generating returns. So it's that combination of public, it's like a great public-private partnership.
Yeah,
maybe is a way to think of it.
A good way to put it. All right, we got to wrap up, but is there anything you wanted to add into this conversation as a way to tie it in a bow?
Yeah, to tie in a bow, I would just say that when someone is selling investment real estate specifically, but really anything that generates a gain, make sure you're talking to the financial planner and the CPA. And when selling investment real estate specifically, opportunity zones are often a real consideration. And people often think 1031 exchange only.
Right.
They need to think about potentially a DST might be right for them, might not, but have that financial advisor run an analysis on the opportunity zone, because that actually might be better than a 1031, depending on the client's needs, risk tolerance, liquidity needs, investment objectives, et cetera. And very few people are making it that far in the evaluation process. So just make sure you don't do that, because you might run it and decide it's not for you, but you might run the scenario and realize, wait a second, this is by far and away the best thing for me. And a lot of people just aren't getting there. So use financial professionals to help you get there.
Jay Frank, Cantor Fitzgerald Asset Management. Great stuff. Thanks for spending the time with us. Really do appreciate it. Find this really intriguing. And if you're interested in learning more, reach out to our office at Asset Management Resources. We're going to take a break. And until next time, keep striving for something more.
Thanks, guys.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.